Hello, Matthew Bell with InsurancePrescription.com, and today I want to talk a little bit about Universal Life, and in specific, I want to talk about the somewhat vexing question of whether or not your Universal Life policy might die before you do. And I know I'm putting it somewhat dramatically, but for a number of people, they discover that a Universal Life policy that maybe they had in place for 10, 20, 30 years is on the verge of collapsing or imploding, and they had no idea that this was even a possibility, or they had forgotten it. So just to start off, we basically have in life insurance, there's temporary insurance and then there's permanent insurance. So the paradigmatic example of temporary insurance is going to be term. Term, you know it's going to be in place for a certain interval, 10 years, 20 years, 30 years, and then after that, you expect and anticipate that that term policy will no longer be in force. Sometimes term policies are renewable, and so there are things that, some niceties, some subtleties that can be added to the conversation, but term insurance basically is the idea that you're going to be covered for a certain term, certain interval, and then that's it. On the other hand, the paradigmatic example of permanent insurance is going to be whole life insurance, and you can just listen to the name, whole life. So the policy there is designed to cover you for the whole of your life, as long as the premiums are paid. That in between term and whole life, in between absolutely temporary and permanent insurance, you're going to have a product that, or a series of products really, that are capable of functioning somewhat like either. And essentially this is going to be variously named adjustable premium, flexible premium. Sometimes it's referred to as Universal Life. There are certain differences between these policies, but they all share in common the fact that they can be more term, more temporary-like, or more whole life or permanent-like, depending on how they're set up and depending on how they're funded. Universal Life has a number of different types. It could be current assumption Universal Life. There's equity indexed, also sometimes called fixed indexed. There's variable Universal Life. There's just a number of these. But the idea essentially with Universal Life is that depending on how it's funded, it could be permanent, but in many cases it's going to turn out to be temporary. And so the surprising thing for some people is that the policy that they know and remember buying, they think of it as permanent insurance, as in place, period, and they come to find out that something has gone wrong and that they're in danger of the policy lapsing or being terminated. Now this came into the fore for a number of people in virtue of a couple of articles that were run recently in the last couple of years. The first one that I'll mention is from the Wall Street Journal, and it was from September of 2018. The title of that article was "Universal Life Insurance, a 1980s Sensation Has Backfired." And then underneath that it says, "A long decline in interest rates caused premiums to soar when they were supposed to stay level." And of course they mention here in the first sentence, this article is by Leslie Sissom, a popular insurance product of the 1980s and 90s has come back to bite many older Americans. The second article that I'll bring to your attention is from the New York Times. This one is from May the 20th, 2016, so a couple of years earlier, and the title there is "Rising Premiums for Universal Life Insurance Draw Scrutiny." Now here, we'll just dive into it a little bit. Some consumers who bought Universal Life policies decades ago are now facing premium increases in the double-digit percentages to maintain policies. Policyholders have limited options since finding affordable replacement policies would probably be difficult now that they are much older, and so they're getting consumer advocates involved. There's even was even a lawsuit against Transamerica. And I don't want to get into all the nitty-gritty, but again, in this article, we see a reference to policies that became popular in the 1980s and 90s when interest rates were higher. Now, the third article that I want to share with you and kind of talk through a little bit is from the Insurance Newsnet, and the title here is "Why Are So Many Universal Life Insurance Policies Failing?" This is from January the 7th of 2019, and they start off with a nod to the Wall Street Journal article. And notice that policy owners did buy Universal Life in 1980s and 1990s because of the interest rate environment. And then they ask the question, the Universal Life is getting a lot of criticism. How much of this is warranted? And were these products, are they deficient? Are they functioning the way they're supposed to? What's actually happened? And their verdict is that these policies are not performing poorly so much as they are not being monitored, and their premium rates are not being adjusted according to the various interest rate environments. What I'd like to do here is just kind of dive into this just a little bit. So I want to keep those two things in mind, not monitoring the policy and not adjusting the rates. And this is why I say some people use adjustable life and universal life in different ways, but here we just see a reference to adjustment of the premium, and it's an application to a universal life policy. So they're a bit interchangeable, at least in this context. I thought I would start with a couple of analogies, and the first analogy is going to be an analogy of putting gas into an automobile. So there's a couple of different ways to go about this. So if you knew you were going to take a trip, and you knew the trip was going to be a certain distance, make up the distance, 100 miles, 200 miles, 50 miles, it doesn't make any difference. If you knew the distance that you had to travel, and if you knew the terrain and how taxing it would be on the vehicle, then there's a couple of different ways to gas the car up. Let's say that the term way of gassing the car up, the temporary way, is to just fill up as you go. You anticipate there being filling stations en route, so you just, doesn't matter how much you put in because you can always just add more. But let's say you wanted to be able to gas the car up so that it could make that entire trip. Well, you've got two different options or two different ways of approaching the strategy of how you're going to gas the car. Let's call the first option the whole life gassing strategy. It sounds kind of weird, but what I mean by that is, in that strategy, we're going to put in as much gas as we think under worst case scenario. We're going to make sure, we're going to add, if we need to, we'll add a second gas tank because we want to make sure that that vehicle is going to get to the destination. And so in a way, you're going to over-gas that car almost for sure. Not if there's a nuclear option, then it might turn out to just be enough. But no matter what, we want to get you to that destination. So whole life is like gassing the car that way. But a second position says, well, you know what? You don't want to go the term route. You don't want to run out of gas halfway through the trip, or 10 miles into the trip, or whatever. You want to get to the end point. But if you're going to overgas the car, that's not the most efficient way to do it. And so the universal life strategy is going to be something like this. Let's suppose, I'm going to make this a really abstract, very simple, very toy example here. But let's say you knew there was a big hill right in the middle of your drive. And you then calculate that if you were able to get your car up to that hill, then you could coast most of the way back down. So in other words, if you knew there was a hill halfway to your destination, then the universal life strategy could be likened to putting enough gas in the car to get you to the hill on the assumption that the downward force of gravity is going to carry you the rest of the way. Now, a couple of things. All analogies break down at some point. There's a number of things wrong with this analogy. For one thing, in life insurance, we don't know precisely where that endpoint destination is going to be because it's your death, right? So we're not sure. Secondly, the idea of there being a hill is problematic. It doesn't translate directly into the life insurance in the same way as it does to the travel example. And another idea here is that we're talking about gassing the car one time, and in many cases the premiums are being paid on an ongoing basis. But the idea I'm trying to express here is that universal life is trying to use something else to get you to the finish line besides just your premium payments. And that's something else. In this case, it's not coasting, it's not gravity. In this case, it is the interest rate environment and it is the market, depending on the type of product that you are talking about. So if it's a current assumption universal life, then it's going to be some kind of a fixed interest rate. And if it is a variable universal life, it's going to be the performance of the market. The second analogy that I'll give is consider throwing something, throwing a ball, maybe hitting a golf ball, and you're trying to hit it a certain distance. So if you are on the tee area and you're trying to hit it onto the green, that's your goal. Now, you're going to take into account certain things, and let's say that wind speed and wind direction is a factor. Let's say that you know the wind is blowing at your back, it's blowing in the direction of the green, and so you calculate that you don't have to hit the ball quite as hard in order to get it onto the green because you've got the wind to assist you. So the whole life strategy would essentially be you just swing like you always swing. But the universal life strategy would be you take into consideration the fact that the wind is going to help you just a little bit, and so you can swing a little bit less. Now that's supposed to be an analogy to putting in a little bit less premium because, again, the interest rate or the market is going to help to propel you to the finish line. Let me try and draw a couple of these things out. The very first way of trying to understand these policies is going to be by understanding the fact that your cost of insurance is going to get a little bit more expensive as you age. So let's consider, first of all, a kind of a curve. So let's consider first of all that this line represents the increase of your premium as you age. So if this is time and this is your premium dollar, we'll call this premium, then as you age, your premium is going to get more expensive. Well, the way that universal life and whole life essentially function are something like this. With whole life, we know, let's say you're going to get out to age 100. And let's suppose that age 100 is somewhere over here on our example. Right? So age 100. Well, with whole life insurance, the idea here is we're going to set the premium up so high that we're going to guarantee that the overpayment, and this represents the overpayment is going to be no problem, because once your cost of insurance exceeds the amount you're putting in, the amount you've added in extra is sufficient to cover the difference that we're missing. You're going to overfund the policy initially, and that overfunding is going to help to cover the deficiency or the shortfall in years where your insurance premium is actually going to be less than your actual cost of insurance. With universal life, it's essentially similar. But with universal life, we think, well, you know what, we don't have to set the premium up so high. We can set it up a little bit lower. And the reason we can set it up lower is because we're not just counting on the premium dollars that are put in to get you to the finish line. Because let's say it doesn't. But what we're also counting on with universal life is the fact that you're going to get some kind of a rate of return on this money. And it may vary depending on the interest rate environment, but that extra money is going to help to propel you all the way to the finish line, if that makes sense. Now, a second way of thinking about this same concept is going to be in a more linear way. So let's just say every year your cost of insurance goes up a little bit. So it is more of a curve rather than an incremental linear change as is supposed over here. But the idea with universal life is essentially this. You're going to set the premium at some arbitrary level. And in the initial years, you're going to be putting in more than your actual cost of insurance. And this difference is going to just sit in a separate account. But it's also going to earn a little bit of interest. Same thing, going to earn a little bit of interest. So in every year that you fund the policy where it earns a little bit of interest, the policy has the ability, using that extra money, to pay into the policy itself in years where you're putting in less than the actual cost. So here it's a deficit, here you're putting in more. And the amount of money that this policy is able to earn in the initial years is supposed to help propel you forward, even in years where your cost of insurance exceeds the amount of premium that you're putting into the policy. Now here I'm going to go back to the article from Insurance News Network because they give an example. They say, consider a 50-year-old male who's putting in $8,800 into his policy every single year. And we anticipate that he's going to have a 3.9% rate of return. And over the course of 50 years, getting him to age 100, that policy on these projections is supposed to get him all the way to age 100. So what the Insurance Newsnet example basically says is, at the age of 70, this person is going to have roughly $80,000 in accumulated cash value, but that accumulated cash value is going to fall so that at age 100, he will only have approximately $9, according to their numbers, $9 left in his cash value. So why does the cash value fall? And the reason the cash value falls is because in the initial years, he's adding in more cash than is required to pay the premium. But as his age advances, his actual cost of insurance goes up, and that cash value starts to lessen and lessen. Now, it can't go completely to zero or negative, or the policy will lapse. So that $9 at age 100 is very important, and it shows that on those assumptions, the policy is capable of crossing the finish line. So think about it like the car that barely glides in on the analogy that I gave with the gas. The car is out of gas, but the car just barely makes it. It made it to its destination. It has served its purpose, and you saved a bunch of money on gas because you were able to coast the final distance. Or consider hitting the golf ball. You were able to conserve a lot of energy, perhaps, because you were able to use the wind to your advantage. So the idea of universal life is to know that you're going to overfund the policy initially, but you're going to overfund it strategically. You're not going to overfund it the way you do in whole life, because in whole life you overfund the policy in the initial years as well. But in that case, We overfund it to such an extent that we don't have to worry if the market's going to not pan out, because we're not counting on the market, we're counting on your funding. So you are funding the policy sufficiently to get it all the way across the finish line. Where in Universal Life, you're not funding it sufficiently unless the assumptions continue to be applicable through the entire illustrated period. So in the example that they gave, again, the interest rate assumption was 3.9%. As long as that 50-year-old gets a 3.9% rate of return, and as long as he puts in $8,800 in his premium year after year after year, then that policy will, even if barely, cross the finish line at age 100. But what happens if the interest rate environment falls? Now, we could entertain the idea that the interest rates could go up. And in that case, he could put in less money and still cross the finish line. So he could reduce his premium. And that's where the flexibility and the adjustability of the premium really pays off. Because if the interest rates go up, you can roll your premium back down. But what is the reality for most people? Because of the interest rate environment, and why this is actually a news item and why it generated a lawsuit isn't because people are having to put in less money than they thought they would need to. It's because they're having to put in more money. And the reason there is because interest rates have not gone up, they've gone down. What happens if the interest rates fall? Well, the idea then is that if the interest rates fall, you didn't get the earnings you thought you were going to get. So there was less money built up, which means there's going to be fewer years that this policy will be able to propel itself forward because you don't have the surplus that you thought you were going to have on the original assumptions. Now go back to the Insurance Newsnet's verdict. They said that the fault was that the policies were not being monitored and they were not being adjusted. Let me just say something quickly about those. So in terms of monitoring, mostly this is going to be the insurance agent. If you don't have a good relationship with your insurance agent, then you should consider getting a new agent or trying to open up a dialogue with him or her, because it's vital, especially with Universal Life, that you monitor the interest rate environment and that you keep track of how your funding strategy is working in conjunction with that environment. And then the second part of that is the adjustability. You have to be prepared to lessen the premium if the interest rate environment goes up, but you have to be prepared to kick in more premium than you've been throwing in if the interest rate environment goes down. So this is where a lot of people run into trouble, because maybe they don't remember being told, or maybe they were not told that this was a possibility. And this is why the idea of it being sold in the 80s and 90s is often a part of the articles that you read about this, because in the 80s and 90s it is conceivable that agents and clients did not conceive of a time when interest rates would be as low as they are right now. So they didn't conceive of a time when this would be an issue. And so maybe it never got brought up. Maybe the policy was sold on the assumption that it was going to be a level premium, interest rates were going to take care of the policy, and that on any realistic assumption, you were going to be able to go all the way out to the end of your life and never have a problem. But because of what's happened with interest rates, it has become a problem and people don't know how to react. So what can you do? Well, the first thing is you could pay more. If the interest rate environment has fallen, you could pay more into your policy. Now, how much more? You're going to want to ask your insurance agent or the insurance company for an in-force illustration or a current illustration. And you're going to want to ask them certain things. You're going to want to ask them, how long will the policy be in force if I continue to pay the same premium I'm paying now? How long would it be in force if I paid no premium at all? And the third question is, what amount would I need to put in to guarantee that that policy is going to cross the finish line? So with those numbers, you're going to be able to get a sense of whether or not it's going to be cost effective to keep the policy, whether you might look at other options. So consider the option where you continue to fund the policy exactly as you've been funding it. Well, if you're experiencing a policy that assumed a higher rate of interest than has been actual, then your policy is almost certainly underperforming, and what you can expect then is that the time interval that policy will be in force is probably going to be compressed. So remember, I started off by saying the Universal Life can be more permanent-like or more temporary-like depending on how it's set up and funded. So if your policy is underperforming and you're not going to kick an additional amount of money, then it's going to look more and more like term. It's going to have a time on it at which it's going to lapse. On the other hand, if you decide you want to kick more money into the policy, you can start pushing that date back, but when you want to ask the question of, can I guarantee that that policy is going to be in force, let's say on the day that I die, can I push it back to age 100, you're going to want to know how much money you're going to have to put into that policy in order to guarantee that eventuality. With those numbers, you're going to be able to make a determination as to whether or not it will be cost effective for you to keep the policy, and it'll be a fair way of assessing whether or not a replacement is viable. So the first thing you're going to want to realize about a replacement is if you are older, certainly you're going to be older than you were in the 80s and 90s, then you're going to have to weigh the increased cost of getting a new policy. You're going to have to ask whether you're in good health. But the important thing to remember is if you want a policy that is going to be guaranteed to be enforced, your policy currently is going to be of no use to you if it lapses at age 70 and you die at age 85. So what you want to remember is that you want to calculate, you want to make a decision based on all the available numbers. And so really the best course of action would be to contact your insurance agent and to have a conversation with him or her about your options. Now the one thing I will add is if your insurance agent has not brought this to your attention, and the insurance agent represents the company or was the person who put this policy in place in the first place, I would consider having a new agent. Because if you do have this problem and that insurance agent has not brought it to your attention, how confident can you be that they're really going to have your interest in mind when they're trying to solve the problem for you if they didn't even point it out to you? So I would say take a look at your options, but definitely request that in-force or current illustration. And if you need help interpreting it, then consult a person who is knowledgeable in that field. Apart from that, I wish you well with the policy. If you found something of use in this video, please like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I hope your policies are not in trouble, but if they are, I hope you found something of use in this video. I look forward to seeing you again in another. Thank you.